Options can be puzzling and intriguing to many investors and traders. So if you want to start options trading, you should first clarify some of the confusion. Before moving ahead, welcome to Upstep Financial. In this video, we will discuss options trading. So please take a brief moment to go down and touch the like button. And if you have not subscribed to our channel yet, go to subscribe to stay connected. Most people are familiar with investment in stock market purchases, and many are likely unaware of terms like options trading. Even so, investing in stocks and holding them to achieve long-term profits is one of the most common investment strategies. It's also a perfectly sensible way to invest if you know which stocks you should buy or use a broker that can offer you exhaustion and guidance on such things. These days, many investors choose to use a more active investment style to try and get more immediate returns. In its most basic form, options trading involves buying and selling options contracts on public exchanges, and it is very similar to stock trading. But on the other hand, stock traders stand to profit by buying shares and then selling them at a higher price. So, in the same way that stock traders can also take a short stock position that they expect will go down in value, options traders can also do the same with options contracts. When trading stocks, there are two ways to make money. Take a long or short position on a specific stock. If you expected the value of a particular stock to rise, you would take a long position by purchasing it to sell it later at a higher price. If you expected a particular stock's value to fall, you would take a short position by short selling it and hoping to buy it back later at a lower price. Conclusion: there is more flexibility in how transactions can be completed in options trading and many more possibilities to earn. It should be noted that options trading is more complicated than stock trading, and the entire idea of what is involved can be highly confusing to newcomers. There is surely a lot you should study before you start investing your money. By saying that, most of the principles aren't that hard to understand. Once you've understood the basics, it'll be much easier to understand what options trading is all about. So, let's see how to trade options. There are 4 simple steps to get started with options trading. Number 1, open an options trading account. Before you continue trading options, you first should confirm that you understand how you're doing. Having an options trading account requires more funds than opening a brokerage account for stock trading. And given the difficulty of predicting several moving parts, brokers must learn more about a potential investor before giving them access to trade options. Brokerage firms screen potential option traders to evaluate their trading experience, risk understanding, and financial condition. These specifics will be documented in an options trading agreement, which will be used to request approval from your prospective broker. Investment goals are important. Income, expansion, capital preservation, and speculation are common examples. Therefore, the broker will be interested in your investment knowledge, how long you have been trading options or stocks, how many trades you make per year, and the number of your trades. Have on hand your liquid net worth or investments, effectively sold for cash and work information. For example, calls, puts, or spreads, and whether they are secured or exposed. The seller or writer of options must provide the basic stock in case the option is exercised. If the writer, moreover, possesses the basic stock, the option position is covered. If the option position is left unprotected, it's exposed. Based on your responses, the broker will generally assign you a first trading level based on risk, ranging from 1 to 5, with 1 being the lowest risk and 5 being the highest. This is the key to making certain types of options trading. Screening should be done in both directions. Your most important investing partner is the broker you select to trade options with. Finding a broker who provides the tools, research, coaching, and support you want is especially important for starting options trading. Hold on. Please click the subscribe button to get alarmed for more updates. And do you have any questions so far? Tell us in the comment below. We will respond to you as soon as possible. Now moving towards step number 2. Pick which options to buy or sell. A call option is a contract that grants you the right but not the obligation to buy a stock at a set price, known as the strike price, within a specific time limit. Likewise, a put option gives you the right to sell shares at a stated price before the contract expires, but not the obligation. What type of options contract to purchase depends on which direction you expect the underlying stock to move. If you feel the stock price will rise, purchase a call option and sell a put option. If you feel the stock price will remain steady, sell a call option or a put option. If you feel the stock price will fall, purchase a put option and sell a call option. So guys, at number 3, we have predict the option strike price. When purchasing an option, it is only beneficial if the stock price exits the expiry period in the money. That is, the price must be either above or below the strike price. It is above the strike for call options and below the strike for put options. As a result, you should buy an option with a strike price that corresponds to where you believe the stock will be over the option's lifetime. For example, if you believe a company's stock is presently selling at $100 and you would increase to $120 at some point in the future, you would purchase a call option with a strike price of fewer than $120. Ideally, a strike price of no more than $120 minus the option's cost, such that the option stays profitable at $120. If the stock rises over the strike price, your option is profitable. Similarly, if you think the company's stock price will fall to $80, you would purchase a put option that gives you the right to sell shares with a strike price greater than $80. A strike price of no less than $80 plus the cost of the option so that the option stays profitable at $80. If the stock falls below the strike price, your option will be triggered. You can't just pick any strike price. Instead, option quotes, also known as an option chain or matrix, include a list of available strike prices. The increase between strike prices are industry standard. For example, $1, $5, and $10, and are dependent on the stock price. The price you pay for options has two components: intrinsic value and time value. If the stock price is higher than the strike, the intrinsic profit is the value between both the strike and the share price. Time value is whatever is left after taking into account the volatility of the stock, the time to expiry, and interest rates, among other things. For example, suppose you have a $100 call option while the stock costs $110. Let's assume the option's premium is $15. Thus, the intrinsic value is $10, while the time value is $5. This leads us to the final spot you need to make before buying an options contract. All right, the very important last step is determine the option time frame. Every options contract includes an expiration term that defines the last day to activate the option. You can't just choose a date out of thin air here either. Your options are limited to those presented when you invoke an option chain. There are two types of options: American and European, and they differ in terms of when the options contract may be executed. Holders of American options can exercise until the expiration date, but European option holders can only activate on the day of expiry. Because American options provide greater freedom for the option buyer while introducing greater risk for the option seller, they often cost more than their European rivals. Expiration dates might range from a few days to several months or even years. Daily and weekly options are the riskiest and should only be traded by experienced option traders. Monthly and yearly expiration periods, on the other hand, are preferred for long-term investors. Longer expirations offer the stock more time to move and your investment thesis more time to play out. As a result, the longer the expiration time, the higher the cost of the option. A longer expiry date is also advantageous, and that's because the option can keep its value even if the underlying stock fall below the strike price. As expiry approaches, the time value of an option depreciates, and options purchasers don't want to see their purchased options decline in value, potentially expiring worthless if the stock closes below the strike price. If a deal goes against them, they can generally sell any remaining timestamp on the options, and this is probably if the options contract is no longer. Like many successful investors, options traders clearly understand their financial objectives and crave position in the market, no doubt. The way you think and approach money in general affects how you trade options. Subsequently, the most excellent thing you can do before you add funds to your account and start trading is clearly defining your investing objectives. So, guys, wrapping up today's video, do you have any questions regarding options trading? Do not hesitate to add your thoughts in the comments section. If you have not subscribed to our channel yet, then subscribe and hit the notification button to get alarmed with our latest content. If you want to make money and enjoy financial freedom, then Upstep Financial is for you. Thanks for your time. Be happy.